Imagine a world where your trading algorithm doesn't just react to market movements, but predicts them before they even happen. That isn't science fiction. That's the reality of quantum computing. The following content is for educational and informational purposes only. Today, global financial giants like JP Chase, Goldman Sachs, and Renaissance Technologies are quietly testing trillions of dollars in assets on quantum-ready algorithms. They know full well that the wall of classical computing is right in front of us. Today's most powerful supercomputers, even those running on thousands of NVIDIA's high-end GPUs, still operate on the traditional structure of binary bits, either 0 or 1. They can calculate only a single computational path at a time. When they have to process 10 million market variables, interest rate fluctuations, geopolitical risks, liquidity pools, and high-frequency order books all at once, it takes them weeks. However, a fault-tolerant quantum computer can evaluate all 10 million paths simultaneously through superposition and entanglement. By the time a classical algorithm processes the very first signal of a market crash, a quantum-driven algorithm will have executed the trade, booked the profit, and already exited the position. This is what we call quantum dominance in finance. Market experts and top research firms estimate that quantum computing will become a $1 trillion sector over the next 10 years, with roughly $110 billion going directly to vendors. To capture this entire multi-billion-dollar opportunity, we have divided the whole market into three distinct strategic layers: infrastructure kings, pure-play hardware builders, and high-asymmetry penny dreamers. First and most foundational are the infrastructure kings: NVIDIA, Microsoft, Amazon, Google, and IBM. These are the monopoly companies running the casino for the entire ecosystem. No matter who wins the hardware race in the market, no quantum processor can run without these companies' infrastructure. The biggest misconception here is that quantum computers will make GPUs obsolete, whereas the truth is that before every single quantum experiment, the need for classical compute power for circuit simulation, testing, and error correction multiplies by 100 times. NVIDIA has captured the entire hybrid quantum classical computing architecture through its CUDA-Q platform, cuQuantum SDK, and DGX Quantum Grace Hopper servers. Microsoft Azure Quantum and Amazon AWS Bracket are generating immediate revenue by selling cloud infrastructure. Internal AWS data shows that for every quantum job, 500 times classical compute hours are consumed compared to the quantum processor runtime, allowing Amazon to make billions from every job. Google has achieved below-threshold error correction with its Willow chip and is generating revenue today from post-quantum security and AI simulation through its spin-out, Sandbox AQ. On the other hand, IBM's Qiskit open-source framework has become the global default operating system for the entire industry, used by over 450,000 developers. For capital preservation and steady compounding, we allocate the largest portion of our base $100 portfolio, specifically $70, to this infrastructure layer. Next, in Layer 2, come the pure-play hardware builders, IonQ, Rigetti Computing, and D-Wave Quantum. These are companies whose entire commercial existence relies solely on quantum hardware. This is where the $110 billion TAM has the most direct impact, giving investors stock price leverage of 20 times, 30 times, or even 50 times. IonQ uses trapped ion technology, where error rates are lowest due to high gate fidelity and long coherence times. Their revenue is scaling at a rapid pace, and they are deeply integrated across all three major platforms: AWS, Microsoft Azure, and Google Cloud. Rigetti Computing focuses on a scalable chiplet architecture, where smaller quantum processors are connected to build a larger modular system. They have their own dedicated Fab 1 chip manufacturing facility and receive multi-million-dollar government backing under the U.S. CHIPS Act. On the third front, D-Wave Quantum follows a completely different route. Instead of waiting for theoretical fault-tolerant gate systems, it solves real-world logistics, supply chain, and portfolio optimization problems using quantum annealing methodology. D-Wave has paying enterprise clients among Forbes Global 2000 companies who are generating real revenue for them today. To create maximum upside and asymmetry, we divide $25 of our portfolio into this pure play layer. Entering layer 3, we have the high asymmetry wildcards and penny dreamers, Quantum Computing Inc., QUBT, Cells Q Corp., LAS, Arkit Quantum, ARQQ, and Microcloud Hologram, HOLO. Important risk warning: penny stocks. Please note, microcap and penny stocks carry extreme volatility, operational risk, and the potential for total capital loss. These speculative plays should only be approached with risk capital you are fully prepared to lose. These are sub-$10 microcap stocks, where volatility is extreme and execution risk is massive. However, if a single government mandate or technology breakthrough hits, you could see exponential returns of 15 times, 30 times, or 50 times. QUBT works on room temperature thin film lithium niobate, TFLN, photonic chips without needing cryogenic cooling, and is building a dedicated foundry in Arizona. Cells Q, LAES, produces post-quantum cybersecurity microchips because, under global regulatory mandates coming in 2027, every Internet of Things device, electric vehicle, and network hardware component will require a quantum-proof encryption upgrade. Arkit, ARQQ, deploys software-driven post-quantum encryption that protects network communications. For investors who want to avoid the volatility of individual stock picking and prefer hands-off risk management, the Defiance Quantum ETF, QTUM, is the most solid tool. It provides diversified basket exposure to 70-plus top quantum, semiconductor, and AI hardware companies under a single ticker, smoothing out violent price dips. In this high asymmetry penny dreamer layer, we allocate just $5 of our capital. Looking at the valuation math and long-term market cap multiplier analysis, this $110 billion direct vendor market is set to completely disrupt overall market capitalizations. Gigacap stocks in the infrastructure layer will deliver baseline returns driven by AI, cloud, and data center growth, while the quantum premium adds an additional 5% to 12% upside booster to their market caps, transforming your $70 allocation into $112 to $143 in a conservative scenario. In the pure play and high asymmetry microcap categories, where direct revenue multiplication occurs, a breakthrough scenario holds the potential to expand your smaller allocations of $25 and $5 by 20 times to 40 times. This means an overall $100 base portfolio could grow to $250 to $370, 10% to 14% CAGR, in a conservative scenario, while in a full breakthrough scenario, it could transform into an asymmetric wealth creator of $1,000 to $2,600 plus. To get the maximum benefit from this entire revolution, the 70-25-5 barbell allocation framework is the most disciplined strategy, where 70% of capital compounds safely in infrastructure, 25% captures direct hardware leverage, and 5% handles asymmetry in moonshot penny plays. Investing in tranches via dollar cost averaging, DCA, and buying on sentiment dips keeps risk completely under control. The $1 trillion quantum computing market is coming, and investors who position themselves in a structured way today will become the biggest financial winners of the next decade.